So why is it that the other central banks are cutting before their 2% inflation target has been reached?
Because 2% is an absolute fantasy, and they're never going to verbalize the fact that the new target is 3.
Are you saying, Thomas, that the Fed is likely to cut before the core PCE gets down to 2%? I think it's at 2.6 now.
100%.
Will the Fed cut rates this year, even if the inflation rate doesn't go back down to the 2% target? And what will happen to the markets in the event of a Fed pivot? Would it be bearish or bullish for stocks? Let's find out with the next guest, hedge fund manager Thomas Hayes, managing member and chairman of Great Hill Capital, and the author of the Hedge Fund Tips newsletter. Great resource for investors. Check it out. Link down below. A word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you want to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below or scan the QR code here to learn more and get started. With Bitcoin having climbed to new all-time highs this year and maintaining its level above $60,000, you may consider an IRA to park your Bitcoin and crypto returns. And if you use my referral link to get started and fund your account, you'll get a $100 signing bonus. Welcome back to the show, Thomas.
Thanks for having me, David. Always great to be here.
One of the biggest worries for the traders and investors that I've been talking to in the last week is the rise of fall of the NVIDIA stock, briefly surpassing all other companies in market cap last week, and then it's retraced about 15%, I think, since its highs. It has the potential to pull down the markets. People tell me, what's your take on what's going on?
Well, it's interesting. I put out my weekly note literally on that Thursday when it was opened at 136, and I called NVIDIA the new pain trade. And of course, in the first hour of trading, it went $3 against us. From 136 to 139. We have no positions in it, but we were basically saying that it's time for NVIDIA to take a rest. And in the next 3 sessions, it dropped 15, 16% peak to trough. I went on Fox Business with Charles Payne. I said, he's like, wow, that was a great call. And I said, yeah, now expect the technical bounce. The next day, we got like an 8% bounce. And now we seem to be rolling back over. Look, it's a great company. It's got great management. It has a great product. It will be a major player in AI. But the key thing here, David, is price is what you pay, value is what you get. And at that point in time, on that Thursday, when we put out the article, the next pain trade on hedgefundtips.com, it was trading up to 41 times sales. You're going to pay for 40 plus years of forward revenues and 51 times of earnings at that point in time with 33% earnings growth. So the other thing was you had a lot of selling. Insiders have sold more in the last few months than you've seen in history. 750 million. Jensen Huang himself sold 94 million, filed to sell up to 750 million in his 10B plan, which is a pittance relative to what he owns, but it's not nothing. So these are the factors that encouraged us to write the article. Probably time for a multi-week or multi-month breather on the NVIDIA front.
And going back to my original question, if it takes a breather, like you just said, will that affect the rest of the S&P?
Okay, so this is a great question. I think what you saw in the first half of the year was interesting in the sense that 60% of the gains were driven by 5 stocks in the S&P 500. I think that's going to be flipped on its head for the second half. And that's not just hope or pray that Powell does the right thing and yada, 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 and gambling on predicting something you can't predict. What that's predicated on is earnings growth. So the outperformance of those concentrated stocks was justified by the earnings growth. For instance, in Q1 of this year, the Magnificent Seven had 50% earnings growth, and the rest of the S&P 500, the unmagnificent 493, had negative 1%. That's why you saw the outperformance of the ones that had the earnings growth. That is going to flip upside down by Q4 of this year. Magnificent Seven will be doing fine, but they're not going to grow at 50%. They're going to grow at 17%. And the unmagnificent 493 are going to grow earnings at 19%, up from negative 1% in the first quarter. So therefore, I think you're going to see a dramatic rotation away from that concentrated, crowded trade. It is the most crowded trade is long Magnificent Seven. The second most crowded trade is short China equities. We could touch on that later. And the other thing that in terms of this sea change, David, is small caps, which only will have 4% earnings growth this year compared to large caps having 12%. But next year, that accelerates to 17.7% earnings growth for small caps and only 14.2% for large caps. So we see an enormous tidal wave sea change coming in the second half and beyond.
So far, though, in the last 30 days or so, the other 8 sectors besides tech, and I think I can't remember the other one, but anyway, 8 of the 10 sectors that I've been looking at have been diverging from the S&P. They've been underperforming. They've been going down, right? Tech is
Yes.
the only sector that's been leading. And in fact, tech is the only sector that's outperformed the rest of the S&P 500. This divergence is that worrying to you for seeing the weakness of the other 493 stocks that you talked about?
Yeah. So the last time, first, the other sector was communication services, which has a bit of overlap. The last time we saw this type of an extreme divergence of this magnitude was the second and third week of October of 2023, which is not that long ago, but most of us have short memories, many investors for sure. And basically, you had a situation where small caps were in the toilet. Anything that wasn't leading was left for dead. And you had a shift in posture from the Fed, namely that the tightening cycle was stopping. It didn't mean the easing cycle was starting, but the tightening cycle was ending. And within 2 months, you basically got 2 years of gains. Everything under the surface that had not performed into that October hole just ripped. And you had stocks up 50%, 100%, literally in 2 months. It was insane. And the divergence we're seeing right now, certainly as you pointed to, David, the last 30, 45 days is even more pronounced than that period. And I think the turn is going to be equally more pronounced, and it's going to be imminent. Now, as it relates to NVIDIA cooling down or taking a breather or even moving lower, and the impact on the indices, I think if you do see underperformance in the Magnificent Seven, doesn't have to mean they crash. It doesn't have to mean that it's 1999 or 2000. It certainly is not, because in some cases the price is underpinned by earnings power and cash flow. What it does mean is they will perform less well than the general indices. Conditions are turning to favor the unmagnificent 493. So you could see a huge amount of stocks under the surface rallying, and you could see the general indices going sideways or maybe up a few percent, but nothing like the first half. And that's further supported by the point of view and the data in the first half of this year. You had a 15% return in the S&P 500 with a max drawdown of 5%, but the average stock had a max loss of 15%, and that even goes more pronounced in the NASDAQ, which was up 18%. The average stock in the NASDAQ had a max drawdown this year of 38%. And then you go to the small caps, Russell 2000, 0% gains through the first half, with the average stock having a max drawdown of 29%. So there's an enormous amount of pain and opportunity under the surface. And I think what people are worried about is if these things slow down, will the indices crash? But the fact of the matter is most of the components have been trading as if the indices are at or near lows, even though the price of the indices supported by a small concentration of stocks is holding up. Many of the stocks underneath are trading like the index is already in pain. And that's why I think you're going to see more of a grind rotation with a lot of money made under the surface, while people in index funds the second half are going to be like, why aren't I gaining anymore? Why is it just going sideways? And big money will be made by stock pickers.
Well, what concerns me isn't that there's a divergence in the sense that the tech sector is leading on the upside. Actually, the other 8 sectors I talked about are going down since the beginning of June. Doesn't that signal to you weakness in the broad stock markets, just taking out the Magnificent Seven tech stocks? Doesn't that signal to you that you should stay possibly on the sidelines or perhaps even short these markets?
Uh, the fundamentals on a company by company basis for the vast majority of the components I'm looking at in the 493 don't support that. And if anything, I think what you have is an issue of Fed posture, and you've got a dual mandate where you've had a tremendous amount of hawkish talk because that's what they have in terms of forward guidance. You're not going to get dovish talk until, in retrospect, they say, here's why we cut. Not we're going to talk dovish until we cut. There's no purpose of not cutting if you're going to talk dovish. So if you're not cutting, the only thing to do is to talk hawkish until you finally cut. And I think that will be the next sea change. Now, you see the numbers moving around this morning. We had 68, we were up to a 68% chance of two cuts by December. Now we're at a 61% chance of two cuts by December. You got a 94% chance of one cut by December, and like a 61 down from 68% chance of one cut by September. I think that is going to be a critical catalyst because they can't ignore the dual mandate when you have initial jobless claims climbing up, you have the unemployment rate climbing up, the employment side starting to crack, and then the two biggest components of inflation, one of them finally cracked, which was auto insurance, which had such a heavy weighting in the measurement. That was the stickiest one, and now we're just waiting on owner's equivalent rent, which has a significant lag. So I think that they're at a crossroads here, and the rest of the developed worlds have figured that out. Switzerland's already cut twice, ECB's cut, Sweden's cut, Canada's cut. We're in a global, I would say easing cycle, but they would say removal of restriction cycle, which I guess is fair when you're 200 bips above inflation in terms of restriction. And I think there's going to be more of that to come. And I think that effectively any company that all the dividend yielders are in the tank because on the basis of cost of capital, anything that has any leverage on their balance sheets are in the tank. So if you get one or two cuts, I think it's a mid-cycle thing, and that's all they'll have to do if they do it soon enough. If they dither and they fumble and they wait till after, the end of the year, chances are they're going to need 4, 6, 8 cuts, and then we got a problem. I don't see it going in that direction because central bank policy is coordinated on a global basis, and the rest of the developed world has already moved, in addition to the Fed, which is back in the market, replacing $35 billion a month as of January 1st as it relates to treasury bond purchases.
That's an excellent point. In what way are they coordinated? Because like you said, the Bank of Canada has cut rates. The Bank of the ECB has cut rates, and now the Fed is not. Right. And I've been getting the feedback that the Fed is looking at domestic data only, but you're saying that it's only a matter of time before they catch up with their peers. Why is that?
Yeah. So during the tightening cycle, when we printed increased money supply by $6 trillion, and then we had to tighten, and the West had to aggressively tighten in a coordinated fashion. Bank of Japan became the global liquidity provider. So they kept easy policy. They not only were buying JGBs, they were buying global sovereign debt from around the world, including US treasuries. And then they went even further out on the risk curve. So they were buying Japanese equities and they were buying global equities through ETFs. That has now played out almost completely. And I say almost completely because the yen is trading at lows, multi-decade lows relative to the US dollar. They will be intervening this month. They've said as much. It was surprising to the markets that they delayed last month, which is part of what you're seeing in terms of these extremes that you referenced earlier. They are going to defend the yen, and they are going to be tightening. If you look at their inflation numbers, tightening is warranted. So they are going to be now completely flipped from being the global liquidity provider to being the only developed central bank that's moving into a restrictive period. As they move into restriction, it should give the Fed the runway to begin some modest, I would say easing. They will say removal of 200 basis points of excess restriction. Call it tomato, tomato. It's the same thing. And they'll be, I think they're going to have cover to do it in September and at the very least by December 1. And they may be able to do one to two and done if they get it early enough. So,
Some
yeah,
people say that the Fed is late to cut, but could we take the view that the other central banks are too early? Let's just take the Bank of Canada, for example. We don't have to talk in depth about the Canadian economy, but the Canadian inflation rate is now at 2.9%, unexpectedly jumped up from 2.7 just a month ago, right? So why is it that the other central banks are cutting before their 2% inflation target has been reached?
because 2% is an absolute fantasy, and they're never going to verbalize the fact that the new target is 3. The fact of the matter is the West it has taken on too much debt, too many deficits, and the only way to get rid of those debt and deficits is to actually inflate it away. So that's exactly what happened from 1948 to 1956. We got debt to GDP to over 120% like we have it right now. We borrowed a massive amount of money to fight a visible enemy at that time. This time we borrowed a massive amount of money to fight a quote unquote invisible enemy, and then excessive spending on top of that. And the only way any government's ever quote unquote paid anything back is in devalued dollars. They will have to run inflation above trend as we did from 1948 to 1956. 3% is the right number. If you look back at history, that's what they did. And within about 8 years, they lowered debt to GDP from 120% down to 63% just by running inflation a little bit above trend during that period. I think we're set up for a similar situation, and that's also underpinned by the demographic demand and growth prospects of 72 millennials at age 33, 34, starting housing, family formation, and demand for capital. So all the things are aligning together. And they'll continue to talk too, but at some point, like Canada, like some of the others, they're going to have to go a little bit early, even if it's only one or two will be sufficient. And to the extent that we need liquidity removal, Bank of Japan will have to step in on a global basis, which they're now incented to do with the yen at nearing historic low levels.
Okay, that's a key point. If it's indeed true that 2% is a fantasy even for the US, are you saying, Thomas, that the Fed is likely to cut before the core PCE gets down to 2%? I think it's at 2.6 now.
100%. I mean, nothing in life is 100%. I'd say 99%. I'd say if you take that bet 1,000 times, 999 times, you're going to be right. Maybe this will be the 1 in 1,000 where you're wrong, but I'd take that bet over and over.
I mean, you've been pretty right so far, at least if you, at least on my program, if you go back out for the viewers, check out Thomas and I's previous interviews. He's made a number of correct calls, including the market, which we'll end on in just a bit. But the Fed has made it pretty clear that 2% is the target. If they flip-flop on this, if they do what you're saying, that's going to make them lose credibility. They don't want to do that, right?
Look, they already have no credibility, right? I mean, they started way too late. They said there was no inflation. They were buying bonds when it was evident that there was already inflation. So no one has any fantasies about them having credibility. It's a question of when they're going to do what's in their own interest. And history says they're going to do it too late. And the other central banks that they've coordinated with throughout the whole COVID process are doing it on time. So I think they'll be the next to follow suit. The fantasy comparison about Arthur Burns and everything else, the conditions were so abjectly dissimilar between that 1970s period and right now from a demographic standpoint. The fact that Arthur Burns' name even comes up in the same sentence as Powell's is mind-boggling to me, and he read the wrong history book. What he should have read is the history book of Alan Greenspan pulling off the perfect soft landing in 1995 to 1996 by acting on time and acting in the right way with 1 to 2 quick cuts and then off to the races.
You mentioned this rising debt. Now, the CBO, Congressional Budget Office, has projected that the deficit will continue to widen into the next decade or so. How does this play out from an investment standpoint? Does a rising debt and deficit levels impact your strategic outlook and positioning at all as a fund manager?
I wouldn't make that same bet. I think that debt to GDP is going to come down. I think inflation is going to, look, the problem we had for 10 years is we couldn't get inflation to come up. And that's a much bigger problem than getting inflation to go down. We know how to get inflation to go down. If we want to tank the economy, if we want to cause defaults, we just keep it restrictive for an excessive amount of time, and you will get inflation down. Deflation, on the other hand, if they dither here, you could wind up in a Japanese type situation. And deflation can be hard to kill for decades if you don't get at it aggressively and quickly. And if you look at 55 some odd percent of inflation components coming down to pre-pandemic levels, below pre-pandemic levels, you would say that and they've acknowledged the two-sided risks are starting to weigh in the favor of deflation. Now, back half of the year, there's some rumblings about freight costs is going to be an issue. But if you deconstruct the components and the weightings, I think that the number one thing that we just have to keep our eyes on is insurance continues to come down. And then finally, we get a little breather on owner's equivalent rent, which I think is going to prove to be the case as we look at all the rental data from around the country.
All this data indicating perhaps a slowdown in inflation, slowdown in economic activity, does it indicate to you a hard landing at all?
I don't think so. I don't think so, because I do see, we basically moved from a destocking cycle. In other words, a lot of the components of the unmagnificent 493 over-ordered during COVID because they couldn't get any supply. Then they spent effectively 7 to 8 quarters from 2001 to 2003 destocking, which impaired their earnings power. And that's now inflecting where the unmagnificent 493 are going through their trough destocking cycle, which for most companies ended like the fourth quarter of 2023, to the restocking cycle, which is why on a lag basis, that earnings power comes back to the back half of the year. And I think that maybe there was some pull forward in the Magnificent Seven, but I think it will be offset by the unmagnificent 493 into the restocking cycle, which historically lasts multiple years. So a lot of these cyclical companies are going to do much better than people anticipate. And even if you think in the scheme of the overall market, David, this year you've got 11.1% earnings growth for the S&P 500. Next year you've got 14.19%, and you got a 21 times multiple, which people say is rich, except for the fact that over the last 24 years, the average earnings growth has been about 6 to 7% compounded with a 17.6 times multiple. So you could say that, we've got a peg of 1.47 if we look out for forward compared to what we'd had historically of 2.81, peg meaning price to earnings growth. Most of it, people think about that in relation to an individual company. But if you think about it in relation to the indices, based on the earnings growth coming out of that destocking cycle into the restocking cycle and the cyclical starting to get earnings power in the back half and in 2024, 2025, there may be space based on earnings growth for more multiple expansion without becoming excessively expensive relative to growth. I'm not making some fantasy bull case because I want to be bullish. I'm just saying that, I'm perfectly comfortable with the idea we could get a pullback, and certainly going to see some volatility before the election. But I think overall, the underpinnings for the 493 and small caps and everything that hasn't worked are so strong right now, with maybe a little Fed catalyst, with certainly an earnings catalyst, with certainly the business cycle turning in their favor and against what's Led's favor. Everything points to generally okay. Now, is this the time to go out and buy an index ETF hand over fist? No, I think you're not going to be super happy or excited about what happens in the next 6 to 9 months from just an index perspective. But if you look at those groups that have been out of favor, I think you can make obscene amounts of money, like many people did from October of 2023 to the first quarter of this year. It was, 2 years of gains in 2 months.
Okay. That's one area of opportunity. Let's finish off on something you said earlier in the beginning of the interview, the short China trade. I'm just going to read you a paragraph from Time magazine, and perhaps we can comment on this. China is in the midst of a profound economic crisis. They write growth rates are flagging as an unsustainable mountain of debt piles up. China's debt to GDP reached 288% in 2023. That's a record. And it talks about how they've been borrowing on assets that don't generate a yield. This is especially true in the housing sector, which says this article, where sales have fallen by a third since pre-pandemic peaks, and new construction is down 60%. This is one of the worst housing crashes in the world over the last 3 decades. What's going on there? How does this translate to trading?
Yeah, I mean, that's exactly what they've had. I mean, if you look at China tech, for instance, it looks exactly like the NASDAQ in 2001 to 2003. In China, it was 2021 to 2023, down, in the case of China, 80 something percent. In the case of the NASDAQ, was down 90%. But if you were a buyer of quality tech in 2001, 2002, you made a fortune over the next few years. I think it'll be similar in China. Look, the fact of the matter is, you had all these high quality Chinese tech companies trading at 30 times. 2 years ago, they're now trading at 8 times, and the cash flows have recovered. The revenues have recovered for the most part. The earnings have recovered. So basically, you have a D-rating of about 66% in terms of the multiple, which is abnormally, below the mean. Certainly 2 years ago was somewhat above the mean. And you have re-accelerating earnings growth. You have the government now focused on consumption, and an enormous meeting coming July 15th to 18th called the third plenary, or whatever the CCP wants to call it. It's quote unquote a big deal. And it deals with all economic policy, and all the data that you referenced are the core subjects of that meeting. And they know they have to do something because, look, at the end of the day, they still have 20, 30% youth unemployment. Last thing you want is a bunch of angry, angry, well-educated young people on the streets, pissed off that they can't find jobs, especially, if you think about a politician's number one job is to keep their own job, and you don't want that to persist. So they've been taking these Band-Aid measures. They haven't done a bazooka yet. They've done some mini bazookas that are taking some effect, but I think we're going to probably see a material change mid-month, and that will hopefully start to re-rate some of these stocks. People will start to pay attention again to the earnings power, and being able to buy, like, in the case of some of these companies, Alibaba is for instance, it's been dead money for a year and a half. It's been moving sideways, building a base like it did in 2016 to 18, and it did from in 2014. And then they take off on these parabolic moves. It's the cheapest AI play in the world, and some smart investors are getting ahead of the sea change, like David Tepper, number one position in his portfolio, almost $1 billion of his own money. And others, like we, have a big position. It's been sitting there. It's been doing nothing for over a year and a half. But I think we're ready, and I think this thing's going to move.
This is my final question. This article states that many Western pundits and politicians view this crisis as a sign of bankruptcy on the part of Chinese communist leadership, but it is more akin to the cyclical debt crises that have plagued capitalist countries throughout history. An apt comparison is Japan's crisis of 1989, which ended decades of high growth and rising asset prices. So, two-part question. First, do you agree that this is a result of just a debt cyclicality issue, or and number two, could this happen to the U.S.?
Look, anything is possible. I think it's unquestionable that the Chinese government, to some extent, has mismanaged things. But then if you look at their GDP growth over the last 4 decades, there's been nothing like it in terms of compound annual growth rate. So, I think when you step back and zoom out and look at the big picture, the fact of the matter is the U.S. has the largest portion of their population, age 33, 34. It's going to drive growth. The growth is going to take care of a lot of the fiscal mismanagement. And in China, believe it or not, they have a very similar setup. They've got the bulk of their population, a large swath of their population, about a year and a half older than the US, but still the bulk. So that's why our view has been, this is like 85 to 89 in Japan, where you are going to have the final blow off. the largest amount of growth in the shortest period of time in China, despite the mismanagement, because of the pure numbers and the age of those numbers. And then I think China, after a 3 to 5 year parabolic move, goes into a multi-decade age of the abyss, like Japan did from '89 until recently. So, for all the China bears, we see your point of view. We think you're 5 years early, just based on demographics and how those work. And as far as the U.S., I think brighter times ahead, certainly because of those 72 million millennials and the demand that they drive from the spending and demand they drive from age 33 to 40, puts us well into the 2030s before we could start to get meaningfully concerned.
Thank you very much, Thomas. Where can we learn more about you and find your work?
Sure. We have a blog called hedgefundtips.com. We publish a weekly podcast called Hedge Fund Tips with Tom Hayes. You can just put it into YouTube or anywhere you get your podcasts. It's one toggles between number 1 to 3 in the hedge fund category for all podcasts. And or reach out to us directly at hedgefundtips.com, on Twitter at hedgefundtips. Same thing on Instagram at official hedge fund tips, and on TikTok at official hedge fund tips. So anywhere you can find us, we're happy to connect.
We'll put those links in the description down below. So make sure to check out Hedge Fund Tips over there and follow Thomas. Thank you very much, Thomas, for your time today. We'll speak again soon.
Appreciate it, David.
Thank you for watching. Don't forget to like and subscribe.